You know, when you think about building a house, there is this really distinct, almost painful phase where it feels like money is just constantly flying out the door.
Oh yeah, the absolute worst phase of the project.
Right, like you're paying your architect, you are handing over these massive checks to the contractors, buying the lumber, the plumbing permits, all of it. It's incredibly stressful.
And every single time you look at your bank account, the balance is lower.
Exactly.
Yeah.
It's lower, and all you have to show for it is like a muddy pit in the ground and some wooden framing, but eventually the dust settles.
Right, the contractors finally pack up their trucks.
Yeah, they sweep the driveway, they leave, and you finally get the keys. And if you decide to rent that house out, suddenly the entire financial dynamic just flips on its head.
It completely reverses.
Right. You aren't spending anymore, you are just collecting the rent. The house transitions from being this massive capital sinkhole into basically a pure cash-generating asset.
And, that transition is one of those powerful financial inflection points you can ever experience in investing.
Oh, absolutely.
You move from funding a vision to, actually harvesting the reality of that vision. The risk profile drops, the cash starts piling up, and the whole narrative around the asset changes.
It goes from, how much is this going to cost me, to how much will this pay me?
Exactly.
Well, welcome to Talk Tickers. This is our latest deep dive. And today we are looking at a company that is going through exactly that transition right now.
A really fascinating pivot.
It really is. We are breaking down Hess Midstream, ticker symbol HESM. We have pulled together the full transcript from their Q4 2025 earnings call.
Right, including the prepared remarks from CEO Jonathan Stein and CFO Mike Chadwick.
Yeah, along with the really revealing Q&A session with Wall Street analysts, folks from Citi, JP Morgan, Goldman Sachs.
The Q&A is where you always find the real story.
Always. And the mission for today's deep dive, our goal here at Talk Tickers, is to cut through all the Wall Street jargon. We want to deliver a plain language, data-forward summary of this massive shift.
And we want to keep the core takeaways tight, under 5 minutes of actual actionable advice, even though we're going to unpack a ton of data today.
Right. We want to figure out exactly what happens to a multi-billion-dollar pipeline company once the pipes are actually in the ground.
Because you look at your portfolio, and you might see guidance for flat growth from a company like this.
And normally your instinct is to sell, right? Flat growth usually means a stagnant business.
Exactly. But today, we're going to unpack why you absolutely shouldn't panic and how this specific company is engineering a massive return of capital to you, the shareholder.
So to understand where this stock is heading, we first need to look at the scoreboard from the end of 2025.
Right, because you can't understand why their flat guidance is actually a hidden catalyst until you understand where they currently stand.
Exactly. So looking at the full year for 2025, it was undeniably a strong year overall. They posted a net income of approximately $685 million.
Which is solid, but
the metric that really matters here, right? The number that actually dictates the health of the business is their adjusted EBITDA.
Yeah, that's the real engine.
And that reached $1.238 billion.
Hitting $1.2 billion in EBITDA is massive, especially because, that metric strips out the heavy non-cash depreciation costs of actually building these physical pipes.
Right. It gives us a true look at their operating cash.
Yeah. And that $1.238 billion, that represents a really solid 9% growth compared to 2024.
So pushing near double-digit operating cash growth on a base that is already well over $1 billion.
It's a very healthy sign of execution because in the midstream sector, you were dealing with massive physical infrastructure.
Tons of heavy metal.
Right. You're laying steel across hundreds of miles of terrain, building compressor stations that cost tens of millions of dollars. The accounting rules mandate that you depreciate the value of those assets over decades.
So that net income of $685 million looks way lower than their actual cash generation?
Exactly, because they are taking those massive depreciation charges on paper every single year, but they aren't writing a physical check for depreciation.
Right. So the underlying cash engine for the full year was incredibly strong. But when we zoom in from that full year picture and look just at the fourth quarter of 2025, the narrative gets a little more complicated.
Yeah, it definitely hit a speed bump.
We saw a sequential dip. So Q4 net income came in at $168 million, which dropped from $176 million in Q3.
Right.
And the Q4 adjusted EBITDA was $309 million, down from $321 million in the third quarter.
And, we both know Wall Street typically hates a sequential decline.
Oh, they panic. Analysts tend to extrapolate any downward movement, right? They assume the business model is fracturing or market share is eroding.
Yeah, if you're holding this stock, seeing Q4 underperform Q3 usually triggers a wave of anxiety.
So, okay, let's unpack this. Should retail investors holding HESM be worried about this sequential dip?
No. Honestly, the anxiety is misplaced in this specific instance.
Why is that?
To understand why it isn't a structural red flag, we have to look past the top-line revenue drop and focus entirely on the margin.
Okay, the margin.
Yeah. CFO Mike Chadwick explicitly noted that Hess Midstream maintained a gross adjusted EBITDA margin of approximately 83% for the fourth quarter.
Wait, an 83% profit margin on the operating level?
Yes, 83%. And they had previously stated their target was 75%.
Wow.
So they absolutely crushed their own target during a quarter where top-line revenues actually shrank.
Okay, that makes no sense to me. How does a company shrink its revenue but somehow manage to keep 83 cents of every single dollar that comes through the door?
It proves the system possesses incredible operating leverage.
Operating leverage. Can you translate that?
Yeah, it basically just refers to the ratio of fixed costs to variable costs in a business model. Think about the physical reality of a pipeline network.
Okay.
Once the trench is dug, the steel is welded, the compressor station is powered up, the cost to keep that system running is largely fixed.
Right, the heavy lifting is done.
Yeah. You have your maintenance crews, your monitoring software, your basic electrical load. If you run that pipe at 80% capacity, your costs are stable.
And if you push it to 100%?
Your costs do not meaningfully increase. I mean, you don't need to hire double the amount of safety inspectors just because the pressure in the pipe is slightly higher.
So the expenses are basically locked in regardless of the volume.
Exactly. So when the volume dips slightly, like it did in Q4, the revenue drops, but the baseline costs remain totally static.
So maintaining an 83% margin through that volume drop just proves they didn't suddenly start bleeding money on operational inefficiencies.
Yeah, they didn't lose control of their pricing power. The physical machinery of the business was operating flawlessly.
So the dip wasn't a failure of management or a breakdown in cost controls?
No, it simply means less physical product entered the front end of the pipe.
Okay, so if the financial engine is flawless, but the supply of fuel for that engine was temporarily choked off, something physical must have happened to stop the oil and gas from flowing, right?
Right, and the transcript points directly to the environment.
Let's look at the story behind those numbers, because CEO Jonathan Stein opens his explanation for the Q4 dip by citing severe winter weather sweeping through the Bakken shale.
Yeah, the Bakken is primarily in North Dakota, which is notorious for brutal, unforgiving winters.
Right. And in December of 2025, a really deep, prolonged freeze settled over the whole region,
which significantly suppressed the volumes of every single commodity flowing through their network.
Let's look at the exact flow rates they reported because they break it down by commodity. So gas processing volumes average 444 million cubic feet per day. Crude terminaling, which is, taking the crude oil from the gathering lines and loading it onto trains or bigger pipelines, that averaged 122,000 barrels of oil per day.
Yep.
And then there is the third category. Water gathering averaged 124,000 barrels water per day for the quarter.
Which is a huge number.
I really need to pause on that number because a barrel is 42 gallons. We are talking about an oil and gas pipeline company moving over 5 million gallons of water every single day.
Yeah, it's wild.
Why is Hess Midstream dealing with that much water?
It is honestly one of the most critical yet frequently ignored aspects of the modern shale industry.
Really?
Yeah. So the Bakken is a tight rock formation. To extract the oil and gas, operators use hydraulic fracturing. They pump millions of gallons of fresh water mixed with sand and chemicals down the wellbore under immense pressure.
Right, to crack the rock open.
Exactly. But that's only the beginning of the water story. The Bakken Formation itself contains vast subterranean reservoirs of prehistoric, highly saline water.
Oh, like ancient ocean water.
Basically, yeah. So when you fracture the rock and open a pathway for the oil to flow up, that ancient water comes up with it. The industry calls this produced water.
And there's a lot of it.
Tons. For every barrel of oil a well produces, it might produce an equal or even greater amount of this produced water.
And this isn't water you can just spray onto a nearby farm field, right?
Oh, definitely not.
Yeah.
It is incredibly toxic to surface life. It's heavily saturated with salt, heavy metals, residual hydrocarbons.
So what do they do with it?
Environmental regulations strictly dictate that it must be safely transported and injected back deep underground into dedicated disposal wells.
Way below any freshwater aquifers.
Right. And in the early days of the shale boom, the logistics of handling this water were a total nightmare.
How are they moving it?
Oil companies would hire massive fleets of heavy tanker trucks. You'd have hundreds of these massive trucks driving out to remote well paths on dirt roads, filling up with salt water, and driving miles to a disposal facility.
That sounds wildly expensive.
It was. And it destroyed the local road infrastructure. Plus, it created a massive bottleneck for production, especially during the winter when roads became impassable.
So Hess Midstream essentially built a toll road specifically for the wastewater.
Exactly. They recognized that replacing those truck fleets with a dedicated pipeline network for produced water was a massive utility-like opportunity.
So by gathering the water via pipeline directly from the well pad, they save the drilling companies a fortune in trucking logistics.
Right. The drillers can produce oil faster without waiting for trucks to show up. And Hess Midstream locks in a highly lucrative, incredibly stable volume stream.
So when they report moving 124,000 barrels of water a day, they're reporting on a critical service that the entire basin relies upon just to function.
Yeah, the water gathering isn't some side project. It's a foundational pillar of the operation.
That makes perfect sense. But returning to the weather issue in Q4, how does a freeze actually stop the oil, gas, and water from flowing?
It's a good question.
Like if the pipes are buried underground, why does cold weather matter?
Well, during the Q&A portion of the earnings call, an analyst named John McKay from Goldman Sachs zeroed in on the exact mechanics of this freeze.
Right.
He wanted to know if the weather issues were a repeat of catastrophic events from past years. Because in the past, the Bakken has seen massive ice storms that literally tore down power lines across the entire state.
Oh, wow. Causing blackouts.
Yeah, cutting power to the wellhead pumps and the midstream compressor stations entirely. And obviously, a blackout physically stops the machinery.
So McKay asked management if Q4 was another grid failure scenario.
Exactly.
Did the power grid fail again?
No. Jonathan Stein clarified that it wasn't a catastrophic power failure this time. It was an issue of extreme, prolonged, ambient cold.
Okay, so just freezing temperatures.
Yeah. The main pipeline arteries are indeed buried below the frost line. The wellheads themselves, the initial gathering lines, the separation equipment, the massive storage tanks, they're all exposed on the surface.
Ah, I see.
When ambient temperatures plunge to 20 or 30 degrees below zero and stay there for weeks, the physical properties of the liquids literally change.
The crude oil becomes highly viscous. It thickens up.
Right. And the produced water, despite all that salt, can begin to freeze in the narrower surface valves. Sensors malfunction. Pneumatic controls freeze up.
The surface infrastructure just seizes up.
Exactly. And beyond the equipment, it just becomes a severe safety hazard for the maintenance crews.
I mean, yeah, you can't have personnel out in negative 30-degree weather trying to saw frozen valves.
Right. So the upstream operators, the companies actually pumping the oil, are forced to proactively throttle back their production.
They just shut the wells in to protect the equipment and the crews.
Yep. And if the upstream operators are pumping less fluid out of the ground, less fluid is entering Hess Midstream's gathering system.
So the volume drop is entirely dictated by the harsh physical reality of operating heavy machinery in the Arctic-like conditions of a North Dakota winter.
It completely demystifies the weather excuse. It isn't a hand wave, you know. It is a physical constraint of the environment.
Okay, that makes total sense. But the transcript also points to a second distinct factor that dragged down the Q4 numbers, right? Third-party volatility.
Yes.
Specifically, management noted lower interruptible third-party volumes in Q4 compared to the third quarter.
This requires a bit of structural context regarding how midstream contracts operate.
Okay, break it down for us.
The vast majority of the capacity on Hess Midstream's pipeline network is reserved for their anchor tenant. Historically, that was Hess Corporation, and following the recent merger, that anchor tenant is now Chevron.
Right. Chevron is the big dog in the room.
Exactly. Chevron pays to guarantee that a massive portion of the pipeline is always available for their specific oil and gas. But Hess Midstream's total physical capacity is slightly larger than what Chevron currently uses.
So they have empty room in the pipe.
Right. And they monetize that empty room by offering it to other smaller independent oil and gas producers operating in the Bakken who need a road to market.
They call these third-party volumes.
Yeah. But the contracts for these smaller players are interruptible.
Meaning what exactly?
Meaning that if Chevron suddenly ramps up production and needs that space, Hess Midstream has the contractual right to immediately kick the third-party volumes off the system.
Just to prioritize their anchor tenant.
Exactly.
So why did those interruptible volumes spike in Q3 and then vanish in Q4?
Well, in the third quarter of 2025, there was a unique anomaly in the broader regional infrastructure. A massive interstate natural gas pipeline, known as the Northern Border Pipeline, had to undergo significant scheduled maintenance.
Okay.
That pipeline is a major arterial route for gas leaving the upper Midwest. When it went into maintenance, its capacity was restricted. Suddenly, a bunch of third-party producers in the region found themselves stranded.
They had gas coming out of the ground, but nowhere to transport it.
Right, because their usual route was choked off. So Hess Midstream stepped in. Because they had that spare interruptible capacity, they were able to absorb a lot of that stranded third-party gas.
They acted as the emergency detour route for the entire region.
Basically, yeah. They captured a temporary windfall of volume and revenue because of a competitor's maintenance schedule.
But by the time the fourth quarter rolled around, the Northern Border Pipeline had completed its maintenance, right?
Yep. It resumed normal operations. Those third-party producers naturally return to their primary permanent transportation routes.
So the temporary surge in volumes on Hess Midstream's system just evaporated.
Exactly. When you stack the normalization of those third-party volumes on top of the severe winter freeze, the sequential revenue dip from Q3 to Q4 becomes entirely logical.
It was a combination of an environmental choke point and the end of a temporary logistical anomaly.
Exactly.
Which brings us to the single most critical piece of the narrative, the elephant in the room that dictates the entire future of this asset.
Oh yeah, this is the big one.
We have touched on it briefly, but we really need to unpack the Chevron integration. Because Hess Corporation, the company that built Hess Midstream, was acquired by Chevron. So Chevron is now the entity pulling the levers. They are deciding where the drilling rigs go, how much capital is spent, and ultimately how much volume flows into the network.
And the transcript reveals a very specific shift in strategy now that a global supermajor is running the show.
And this shift in strategy is, the defining catalyst for the next decade of this company's existence?
I would say so, absolutely. See, when an independent company like Hess Corporation operates a basin, their primary goal is often aggressive top-line growth.
Right. They want to show Wall Street that they can increase production by 10 or 15% every year to justify a growth multiple on their stock.
Exactly. But when a supermajor like Chevron acquires that basin, the philosophy changes entirely.
Because Chevron has assets all over the planet.
Right. They have deep water platforms in the Gulf of Mexico, massive liquefied natural gas facilities in Australia, sprawling acreage in the Permian Basin in Texas.
They do not need the Bakken to be a hyper-growth engine.
No, they need it to be a highly efficient, predictable cash cow.
And CEO Jonathan Stein explicitly outlined Chevron's new operational target during the call. He stated that Chevron is targeting a plateau production rate of 200,000 barrels of oil equivalent per day in the Bakken.
Plateau production is the key phrase there. Chevron has read the geological models, analyzed the decline curves, and they've determined that trying to force the Bakken to produce 300,000 or 400,000 barrels a day would require massive, inefficient capital spending.
So instead, holding the production steady at a plateau of 200,000 barrels a day maximizes the profitability of every single barrel extracted.
It is the absolute optimal equilibrium point for the asset.
But to maintain that 200,000 barrel plateau, the transcript shows Chevron is making a fascinating operational change.
Yeah, this part is really interesting.
They are reducing the number of active drilling rigs in the Bakken from 4 down to 3. And yet they are maintaining the exact same production volume.
Right.
Management explains this by saying Chevron is drilling longer laterals. Now, we need to really dig into the engineering of this because it sounds completely counterintuitive.
It does. At first glance.
How do you pull the same amount of oil out of the ground with 25% fewer drilling rigs? I'm trying to picture this mechanically.
Okay, let's break it down.
Like, if Chevron were a retail company, my instinct is to say they are closing down smaller neighborhood stores and replacing them with one massive big box supercenter. You know, they have fewer total locations, but the one big location does the sales volume of 4 small ones. Does that analogy work for what they are doing underground?
The retail analogy touches on the consolidation aspect for sure, but it misses the specific logistical advantage that impacts the pipeline company.
Okay, so what's a better way to look at it?
To truly understand why longer laterals are so beneficial to Hess Midstream, we need to think about logistics and transportation. Imagine Chevron is a massive freight company, and Hess Midstream is the private toll road they are forced to use.
Okay, I'm with you.
Under the old strategy with 4 rigs, Chevron was basically buying a massive fleet of small delivery vans. They would send all these small vans out to pick up cargo. And to accommodate that strategy, Hess Midstream had to spend hundreds of millions of dollars building dozens of individual custom on-ramps all over the highway system just so those little vans could get onto the road.
Building those on-ramps is what they call well connect capital.
Precisely. Every new well pad requires a new physical pipeline connection.
Got it.
Now, Chevron takes over and looks at this logistical nightmare. They realize it is wildly inefficient to manage a fleet of tiny vans. So they fire a quarter of their drivers, dropping from 4 rigs to 3, and they replace the small vans with massive, high-capacity 18-wheeler semi-trucks.
Okay, so the 18-wheelers carry the exact same total amount of cargo as the fleet of vans did.
Right. The total volume moving down the highway remains exactly the same. But here is the magic for Hess Midstream. Because there are fewer vehicles originating from fewer starting points, Hess Midstream doesn't have to build nearly as many expensive on-ramps.
Wow. They still collect the toll on the massive cargo volume, but they stop spending their own money building the infrastructure to gather it.
That is the exact dynamic of a longer lateral.
That's incredible.
In shale drilling, a rig drills down vertically for perhaps 2 miles to reach the target rock layer. Then the drill bit turns 90 degrees and drills horizontally through the oil-bearing rock. That horizontal section is the lateral.
And historically, how long was that?
A lateral might be 1 mile long. You would frack that 1 mile section, extract the oil, and then move the rig to a completely new location to drill another well.
And moving a rig is incredibly expensive and time-consuming.
Very. So Chevron's strategy is to leave the rig in one place and push the limits of engineering. They are drilling 2-mile or even 3-mile laterals.
The friction and the pressure of steering a drill bit horizontally 3 miles underground, I mean, that must be staggering.
It requires immense technological precision. But the economic payoff is massive. A single surface well pad can now access 3 times the amount of subterranean reservoir rock.
Chevron spends less money moving rigs around the surface.
Exactly. And Hess Midstream spends significantly less money building physical gathering lines to connect scattered well pads. They build one connection to a single, hyper-productive well pad, and that well flows enormous volumes for an extended period.
So this optimization strategy is the fundamental reason Hess Midstream was able to post that 83% margin we discussed earlier.
Yes. The physical footprint of the operation is shrinking, the capital required to connect new wells is plummeting, but the sheer volume of hydrocarbons flowing through the main arteries remains locked at that 200,000 barrel plateau.
Okay, so if the optimization is that successful and the massive foundational infrastructure, the big compressor stations, the main gas processing plants is already built, what does management actually expect this business to look like as we move forward into 2026?
That question brings us directly into the guidance section of the earnings call. And the guidance management provided is, frankly, a masterclass in managing Wall Street's expectations while highlighting a massive underlying financial pivot.
The guidance starts with a very stark warning for the immediate future, right? CFO Mike Chadwick did not sugarcoat the first quarter of 2026.
No, he did not.
The severe winter weather that ravaged the volumes in Q4 didn't just magically dissipate when the calendar flipped to January.
Unfortunately not. The deep freeze entrenched itself over North Dakota. Chadwick laid out plainly that the weather impacts continued relentlessly through January and well into February of 2026.
So the same physical constraints, the freezing wellheads, the highly viscous crude, the hazardous conditions for maintenance crews, were still actively suppressing production.
Right. They are telling analysts not to expect a miraculous recovery in the Q1 numbers.
Yeah, they issued muted guidance for the first quarter. They projected net income to land between $150 and $160 million, and adjusted EBITDA to come in between $295 and $305 million.
Which is a sequential step down even from the depressed $309 million they just posted in Q4.
They are preemptively managing the narrative, ensuring Wall Street doesn't panic when the Q1 numbers officially print.
It is a necessary clearing of the deck. But the true narrative of this earnings call reveals itself when we zoom out from the localized winter freeze and look at their guidance for the full year of 2026.
Right, because management is expecting full-year adjusted EBITDA to land between $1.225 billion and $1.275 billion.
And if you take the midpoint of that range, $1.25 billion, it is almost exactly the $1.238 billion they generated in 2025.
It is essentially flat.
Yes, flat.
And this is where I have to interject with some genuine skepticism, because we both know how the market operates. Wall Street is pathologically obsessed with growth.
Oh, totally.
If a tech company or a consumer brand comes out and guides for absolutely zero year-over-year earnings growth, the market slaughters the stock. Analysts issue downgrade notes, the momentum traders liquidate their positions, and the stock is labeled a value trap.
It happens all the time.
Right. So you're looking at your portfolio, you see this flat guidance, and every instinct tells you that a company with flat earnings is a dead stock. Why on earth should any investor be excited about a business that is explicitly telling you they are not going to grow their operating profit next year?
Because in the mature infrastructure sector, looking solely at EBITDA is looking at a fundamentally incomplete picture.
How so?
EBITDA tells you what the operations generated, but it does not tell you what the business actually cost to maintain and expand. The metric that dictates true shareholder value, the metric that determines how much actual cash is left over to pay dividends or buy back stock, is free cash flow.
Free cash flow.
Yes. And to understand why Hess Midstream's free cash flow is about to explode despite flat EBITDA, we have to look at the most significant catalyst revealed in this entire presentation.
The CapEx cliff.
The CapEx cliff.
Okay, walk us through exactly what that means.
CapEx stands for capital expenditures. It represents the actual hard cash the company spends on physical construction, buying steel pipe, pouring concrete foundations for compressor stations, purchasing massive industrial valves.
Right, the stuff you need to build the system.
Exactly. For the last several years, Hess Midstream has been in a heavy, aggressive build-out phase. They were spending hundreds of millions of dollars every single year to build out the backbone of their gathering system and expand their gas processing plants to handle the anticipated volume from the Bakken.
So they were in that painful house building phase we described at the beginning of the show.
Yep. The money was constantly flying out the door to fund the vision. But during this call, Jonathan Stein made a definitive announcement. The system is now substantially built.
They have finished the house.
They have finished the house. They have enough physical capacity in the ground right now to comfortably handle Chevron's targeted 200,000 barrel a day plateau. Because the heavy lifting is done, their capital spending is plunging. In 2026, they expect total capital expenditures to be approximately $150 million.
That represents a massive 40% reduction relative to what they spent in 2025.
And the transcript shows this isn't just a one-year dip either. They project that by 2027 and 2028, their CapEx will drop to less than $75 million per year.
That is the cliff.
That is the cliff. They are dropping from a peak of hundreds of millions of dollars down to a baseline maintenance level of under $75 million. The mathematics of free cash flow are incredibly straightforward. Free cash flow equals your operating cash, your EBITDA, minus your capital expenditures.
See, this is the massive disconnect that casual investors completely miss when they only scan the headline revenue numbers. Even if the top-line EBITDA stays perfectly flat at $1.25 billion, if the amount of cash you are burning on construction drops by 40%, the amount of cash left over in the bank account has to surge upward.
And surge it will. Management is guiding for adjusted free cash flow in 2026 to jump by 12%, reaching between $850 million and $900 million.
That's incredible.
And because that CapEx continues to step down in the subsequent years, they expect their free cash flow to grow at a massive annualized rate of 10% all the way through 2028.
So you have a business with flat revenue that is simultaneously generating double-digit compounding cash flow growth.
That is the definition of transitioning into a cash cow.
Yeah. But during the Q&A, an analyst named Eli from JP Morgan specifically pressed management on this exact dynamic.
He did.
He wanted to understand the mechanics behind this massive free cash flow surge heading into 2028. He asked if this outlook was merely the result of an aggressive internal cost-cutting program or if it was structurally sustainable.
And Jonathan Stein's response to Eli was critical. He clarified that they are not slashing vital maintenance budgets or hollowing out the company just to juice the free cash flow metrics for Wall Street.
Okay.
The ability to drop CapEx to under $75 million is a direct structural result of historical overinvestment and the Chevron optimization strategy we discussed.
They pre-built the capacity.
Exactly. The $75 million a year they will spend in 2027 and 2028 is essentially just routine system maintenance and the minimal capital required to connect those highly efficient multi-mile lateral wells that Chevron is drilling. They are in pure harvest mode.
Okay, wait, hold on. I need to interrupt here because we just spent a significant amount of time detailing how a severe winter freeze can completely paralyze their volume.
Sure.
We talked about how extreme cold forced upstream operators to shut in wells. If the volumes can drop that dramatically due to weather, or if global oil prices tank next year and Chevron simply decides to stop drilling entirely to save capital, doesn't this entire free cash flow projection instantly evaporate?
A fair point.
I mean, how can they confidently project nearly $1 billion in free cash flow if they cannot control the weather or global commodity prices?
That is the exact vulnerability that terrifies most investors in the energy space. You are entirely dependent on the throughput of the commodity.
Right.
But Hess Midstream possesses a structural insurance policy built directly into their business model that fundamentally insulates them from that exact scenario.
Okay, what is it?
It is a contractual mechanism known as minimum volume commitments, or MVCs.
Okay, let's clearly define what an MVC actually is and how it functions.
So when Hess Midstream decided to spend hundreds of millions of dollars building this massive infrastructure network in the Bakken, they did not just build it on speculation.
They didn't lay the pipe and hope someone would eventually use it.
No. They went to Hess Corporation and by extension, Chevron, and negotiated a legally binding long-term contract. The contract stipulates that Hess Midstream will build and maintain the physical pipeline. But in exchange, Chevron guarantees that they will send a specific minimum amount of volume through that pipeline every single year.
A guaranteed baseline of traffic.
Yes. And here is the crucial mechanism.
Yeah.
It is a take-or-pay contract.
Take or pay.
Right. If Chevron successfully drills the wells and pushes the guaranteed volume of oil and gas through the system, Chevron pays the agreed-upon toll fee.
Sure.
But if the weather freezes the wellheads, or if oil prices crash and Chevron stops drilling and they fail to meet that minimum volume threshold, Chevron still has to pay Hess Midstream the toll fee as if the oil had actually flowed.
Chevron pays them regardless of physical reality. That is an astonishing amount of leverage for a midstream company to hold.
It really is.
So how much of Hess Midstream's expected revenue is actually shielded by these MVCs?
CFO Mike Chadwick explicitly quantified this during the call. For the year 2026, approximately 95% of their expected revenues are protected by minimum volume commitments.
Wait, 95%.
95%.
So virtually their entire top line is contractually guaranteed.
Yes. When management issues guidance for $1.25 billion in EBITDA, it is not a speculative forecast based on a perfect macroeconomic environment. It is not a hope that the weather stays mild and oil prices stay high.
Because 95% of that $1.25 billion is backed by a rock-solid contract with Chevron, which happens to be one of the largest, most heavily capitalized corporations on the planet.
Exactly.
Let me get this straight. If the Bakken winter freeze had continued unabated all the way through June, if half the basin was completely shut down and physical volumes plummeted to near zero, Hess Midstream would still collect 95% of their projected revenue.
Yes.
That is insane.
And Mike Chadwick specifically leveraged this fact during the Q&A to calm Wall Street's nerves about the prolonged Q1 freeze.
Right.
When John McKay from Goldman Sachs asked about the path to recovery from the weather impacts, Chadwick basically shrugged it off financially. He said they obviously expect physical volumes to recover as the weather warms in the second and third quarter.
Sure, physically it will recover.
But he forcefully added that even if the physical production were to remain suppressed for the entire year, 95% of their revenue is covered by the MVCs. The financial floor underneath this company is virtually impenetrable for 2026.
Wow. Okay, let's synthesize everything we have covered so far because the setup is extraordinary. We are looking at a midstream company that has completely finished its heavy, expensive construction phase.
Yep.
Their capital expenditures are plummeting off a cliff, dropping from hundreds of millions of dollars down to a baseline of under $75 million by 2027.
Exactly.
Because you no longer have to burn cash on construction. Their free cash flow is exploding upward, projected to hit nearly $900 million next year.
Right.
And the revenue generating that massive pile of cash is 95% guaranteed by a take-or-pay contract with a global supermajor, completely insulating them from commodity price crashes or severe weather events.
That is the architectural blueprint of a pure cash-generating machine.
Which naturally forces us to ask the ultimate question. If you are generating nearly $1 billion of free cash flow and you only need $150 million to run and maintain the business, you have a massive growing pile of unallocated cash sitting on your balance sheet.
A huge pile.
Management expects to have over $1 billion of financial flexibility accumulated through 2028. What is this management team actually going to do with all that money?
Yeah, that's a big question.
And more importantly, what is the actionable takeaway for you, the listener, looking at this stock for your portfolio?
Well, the capital allocation strategy dictates the entire investment thesis here. Based on the explicit guidance provided in this transcript, we can form a very definitive stance on who should and who should not own this stock.
Okay, let's hear it.
If you are an investor chasing aggressive top-line growth, if you are looking for a company that is going to double its revenue in the next 3 years, expand into completely new markets, or invent a new technology, this is absolutely not the stock for you.
Right.
The stance on Hess Midstream as a pure growth play is neutral at best. The Bakken production is plateauing, the infrastructure footprint is static, and top-line earnings are flat.
But if your investment horizon is different,
Right, if you are an income investor, a dividend growth investor, or someone seeking a high-yield, deeply insulated compounder to anchor the conservative side of your portfolio, the stance is strongly bullish.
strongly bullish.
And that bullishness is entirely predicated on management's highly disciplined framework for returning all that excess cash to you.
And Jonathan Stein laid out their capital return priorities with absolute clarity. Priority number 1 is a stated targeted 5% annual growth rate for their Class A share distributions, extending all the way through 2028.
Yeah, let's clarify the jargon real quick.
Yeah.
In the midstream partnership structure, they pay distributions. But for you holding the Class A stock in your brokerage account, it functions exactly like a traditional quarterly dividend.
They are committing to giving you a 5% raise on your dividend every single year for the next 3 years, funded entirely by their guaranteed free cash flow.
Right. Now, in the context of hypergrowth tech stocks, a 5% annual growth rate might sound completely uninspiring.
Yeah, it doesn't sound like much.
But you must contextualize that growth against the starting yield. Midstream companies traditionally offer very high baseline dividend yields. When you take a high initial yield and compound it by an inescapable 5% every year, backed by a take-or-pay contract, you are creating a massive, highly predictable wealth compounding engine.
It is the tortoise beating the hare. But the truly staggering part of their financial modeling is what happens after they pay that dividend.
Oh yeah, the excess.
Mike Chadwick walked the analysts through the math. He noted that in 2026, after fully funding all of their operational expenses, fully funding their $150 million CapEx budget, and fully funding that growing 5% dividend payout to every single shareholder,
Right.
Hess Midstream will still have approximately $210 million in what he termed excess adjusted free cash flow.
Pure, unassigned surplus cash.
$210 million just sitting there. In the energy sector, excess cash can be incredibly dangerous.
Very dangerous.
When oil executives get their hands on a massive pile of surplus cash, the temptation to do something reckless is overwhelming. Do they go out and attempt a massive, wildly overpriced acquisition of a competing pipeline? Do they try to expand into a completely different basin where they have no geological expertise? Do they issue a massive one-time special dividend that drains the treasury? What exactly are they doing with this surplus?
This is where the transcript highlights the deeply conservative, almost boring discipline of this specific management team.
Boring is good sometimes.
Very good. During the Q&A, Doug Irwin from Cydia explicitly probed them on this exact pile of cash. Irwin wanted to understand their long-term balance sheet philosophy. Historically, Hess Midstream operated with a financial target of keeping their total debt at roughly 3 times their annual EBITDA.
Right.
Irwin asked if they were revising that target downward and how the $210 million of excess cash factored into their leverage goals.
How did Mike Chadwick respond to the leverage question?
Chadwick outlined a very measured, balanced approach that should thrill any conservative investor. He stated that they have no intention of pursuing wild acquisitions or risky expansion projects.
Thank goodness.
Instead, they are going to deploy that $210 million of excess free cash flow toward 2 highly accretive goals: paying down their existing debt load and executing incremental, opportunistic share repurchases.
They are using the surplus cash to buy back their own stock and wipe out their corporate debt.
And Chadwick explained the mechanical result of this strategy because their baseline EBITDA is designed to grow very slightly over time, thanks to fixed inflation escalators built into their contracts with Chevron.
Right.
And because they are simultaneously using the excess cash to pay down the absolute total amount of debt on the balance sheet, their leverage ratio is naturally going to drift downward. They expect it to naturally fall below that historical 3x target over the coming years without requiring any drastic structural changes.
Let's translate the mechanics of that strategy because the compounding effect is beautiful.
It really is.
You have a company that already boasts an impenetrable 95% revenue guarantee from Chevron. Instead of resting on that safety net, they are actively making the company even safer by aggressively retiring their debt.
They are essentially using their excess cash to fortify the castle walls.
Exactly.
Retiring debt in a high interest rate environment is one of the most guaranteed returns on capital a management team can execute. Every dollar of debt they pay off permanently eliminates the associated interest expense.
And when interest expense drops, their free cash flow expands even further in the subsequent quarters.
It creates a self-feeding loop of financial strength.
And when you combine the debt paydown with the share repurchases, the math gets even better. By stepping into the open market and buying back their own stock, they are permanently reducing the total number of outstanding shares.
Right.
When the share count drops, that guaranteed 5% dividend growth is suddenly spread across fewer total shares.
Which makes the dividend significantly cheaper for the company to sustain long-term, further expanding their safety margin. It is a masterclass in financial engineering. But unlike the hollow financial engineering you see on Wall Street, this is backed by hundreds of millions of dollars of real physical cash flow generated by heavy steel infrastructure.
When you step back and evaluate the entire landscape presented in this earnings call, it becomes clear that Hess Midstream has structurally transformed.
Totally.
It is no longer an upstream exploration proxy. It is no longer a growth at all costs shale story. It has fundamentally morphed into a high-yield, deeply entrenched utility company.
The narrative might seem boring now that the heavy construction phase is complete and the CapEx cliff has been reached, but the financial architecture is engineered down to the final decimal point to relentlessly print money and return it to the shareholder.
Yeah.
In a broader energy market defined by chaotic volatility, where a geopolitical crisis halfway across the world can swing oil prices by $20 overnight, or where a sudden regulatory shift can destroy a business model, Hess Midstream offers a rare sanctuary.
Having 95% of your revenue contractually insulated from price shocks, combined with guaranteed dividend growth funded entirely by internal cash while simultaneously paying down debt, it is the definition of a financial safety harbor.
It is a brilliantly constructed safety harbor.
But you know our philosophy here on Dock Tickers. We cannot simply present the bullish thesis, applaud the management team, and send you on your way without examining the structural cracks in the armor.
We have to look at the downside.
If you are going to put your hard-earned capital into this stock, you must understand the long-term existential threats hiding just over the horizon.
We have to look past the immediate safety net of 2026 and examine the structural integrity of the contracts moving into the next decade.
And that brings us to the final provocative thought we want to leave you with today. It revolves entirely around the minimum volume commitments, the MVCs that we just spent the last 20 minutes praising as the ultimate insurance policy.
The insurance policy is flawless for the immediate future, but the transcript reveals a critical detail about its longevity.
Exactly. We established that for 2026, 95% of Hess Midstream's revenue is fully protected by Chevron's take-or-pay guarantee. But that 95% coverage ratio is not permanent.
No, it's not.
The contracts have a step-down mechanism. The transcript explicitly notes that the MVC protection drops from 95% down to 90% in 2027, and then it drops again to 80% in 2028.
A coverage ratio of 80% is still remarkably strong for a midstream asset, but the trend line is undeniable. The safety net is slowly, methodically lowering.
And here is the thread you need to pull on if you are holding this stock in your portfolio. Hess Midstream's tariff rates, the actual toll fee they charge for moving the oil reset annually, and their contracts include inflation escalators that are strictly capped at 3%.
Okay.
With their fixed fee MVCs and their plunging CapEx, they are a uniquely well-insulated cash machine right this very second. But you have to remember who is sitting on the other side of that contract.
Chevron.
Chevron is not a regional North Dakota driller. Chevron is a sprawling global supermajor. They possess massive, highly lucrative assets in the Permian Basin in Texas. They operate billion-dollar deepwater platforms in the Gulf of Mexico. They manage massive liquefied natural gas export terminals in Australia.
They have options everywhere.
Chevron allocates its capital globally, seeking the highest possible return on every dollar spent.
Which introduces the ultimate variable into the Hess Midstream equation.
What happens if, 5 or 6 years from now, Chevron's internal geologists look at the Bakken shale and decide that the prime Tier 1 drilling inventory is finally tapped out?
That's a real possibility.
What if the oil is simply getting too hard or too expensive to extract compared to their assets in Texas or the Gulf? If Chevron decides to strategically pivot their capital allocation away from North Dakota entirely, they will slowly stop drilling new wells in the Bakken.
And if a producer stops drilling new frac wells, the physics of shale dictate that production will inevitably fall. Shale wells have steep natural decline curves. The volume of oil flowing into Hess Midstream's pipes will naturally and steadily drop as the existing wells deplete.
Right now, in 2026, the 95% MVC coverage completely protects Hess Midstream from that exact scenario. If Chevron stops drilling tomorrow, Chevron still has to write the massive check. But what happens after 2028? What happens in 2030? When the insurance policy drops below 80%, or when the initial 10-year contracts on certain older gathering systems expire entirely? What happens to this beautiful, high-yield, compounding cash cow when the guaranteed toll payer simply decides to pack up their trucks and drive down a completely different highway?
It is the existential, inescapable question for any midstream pipeline company that is tied entirely to a single geographic basin and relies overwhelmingly on a single anchor tenant.
You are fundamentally tethered to Chevron's capital allocation strategy.
As long as Chevron remains financially committed to maintaining that 200,000 barrel a day plateau in the Bakken, Hess Midstream operates as an impenetrable fortress of cash flow.
But if Chevron's commitment to North Dakota ever wavers in the next decade, the walls of that fortress will start to look incredibly thin.
It is the ultimate caveat to the utility thesis. If you are buying this stock to hold for the next decade, you cannot simply put it in a drawer and forget about it.
Yeah.
You must monitor Chevron's corporate actions, their global capital expenditure budgets, and their rig counts just as obsessively as you monitor Hess Midstream's quarterly earnings reports.
Because in the heavy infrastructure pipeline business, your multi-billion-dollar asset is ultimately only as strong and only as valuable as the company pushing the oil into the front end of your pipes.
Will said.
It all comes back to the foundation. The transition from a massive cash-burning capital build-out phase into a highly lucrative free cash flow harvesting machine is officially complete.
Yep, the house is built.
The stunning 83% operating margins prove that the physical machinery is incredibly efficient. The massive CapEx cliff guarantees that a tidal wave of cash is about to hit the balance sheet. And the minimum volume commitments provide an ironclad safety net for the immediate future, allowing management to aggressively raise your dividend and buy back stock.
For the next few years, it is a landlord's dream.
Now, it is just a question of how long that massive, wealthy tenant decides to stay in the neighborhood before looking for a new place to live. Thank you for joining us on this exhaustive, granular journey through the Hess Midstream Q4 earnings call. As always, we highly encourage you to pull up the source transcripts and review the specific flow rates, the CapEx guidance, and the exact wording of the analyst Q&A we discussed today. You've been listening to Talk Tickers. We will see you next time.